Welcome to This Explainer. Today, we're building a complete financial engine from the ground up. If you've ever wondered how capital actually flows, or how conventional and Islamic finance run on parallel tracks to literally drive our world, well, you're in the right place. We're going to pop the hood and look directly at the mechanics.
All right, let's dive right in with the ultimate question. What exactly are the mechanics that keep a massive economy moving smoothly? You know, it's not just magic. It's a highly engineered system of institutions, markets, and core principles that basically dictate how money is created, moved around, and multiplied.
So, here's our roadmap for today. We're going to cover the global financial engine, money and capital markets, the principles of Islamic finance, equities, REITs and ETFs, bonds versus Islamic sukuk, and finally, we'll wrap up out on the crypto and forex frontier. Okay, Section 1, the global financial engine. Bank Negara Malaysia, and the dashboard. So in Malaysia, Bank Negara Malaysia, or BNM, sits squarely in the driver's seat. Think of them as the absolute apex of the monetary structure. Their job? To constantly watch the dashboard for inflation, ensure price stability, and steer the credit situation to safely mobilize resources. They're the ones deciding if the engine needs a little more gas or if it's time to tap the brakes. And the central bank's main accelerator pedal is what we call the overnight policy rate, or OPR. Back in July 2020, to jumpstart a pandemic-stalled economy, BNM actually pushed this rate down to a historic low of 1.75%. Lowering this rate makes borrowing cheaper, which means lower interest on things like your home or car loans, and that pumps much-needed liquidity right into the engine to keep the wheels turning.
Moving on to Section 2, money and capital markets, the gears and the wheels.
To really visualize this, think of the short-term money markets as the gears managing the immediate day-to-day liquidity. Meanwhile, the long-term capital markets? Those are the wheels that are actually moving businesses forward over the long haul. You absolutely need both of these for the vehicle to function.
The distinction here is super important. The gears are money markets handle daily cash flow mismatches through things like overnight interbank lending. It's strictly for short-term funds, so anything under 12 months. The wheels, on the other hand, handle the capital markets. That's long-term financing. It's where you find perpetual equities and multi-year corporate bonds traded on stock exchanges to fund massive corporate projects.
All right, Section 3, Principles of Islamic Finance, the Ethical Engine Upgrade.
Now, this alternative engine is strictly governed by primary and secondary Sharia sources, which fundamentally shifts the mechanics of how the finance works. It absolutely prohibits riba, which is interest, gharar, meaning excessive uncertainty, and maisir, which is gambling. Because a bank can't just sit back and charge interest for lending money, these financial institutions had to completely re-engineer how they generate profit. They had to shift away from debt-based lending and move entirely toward trade and profit-sharing models.
So the crucial takeaway here is how this changes specific parts of our engine. Let's look at insurance. Conventional insurance is essentially a commercial risk transfer system that relies heavily on interest-bearing investments. But in the Islamic system, this gets replaced by takaful. Takaful is a mutual help system based on tabaru, or donation. Participants pool their money to guarantee each other against loss, which totally eliminates those un-Islamic elements of commercial uncertainty and interest.
Section 4, equities, REITs, and ETFs, the special components.
So how exactly do you finance international trade if you can't charge interest? Well, instead of a standard interest-based loan, an Islamic bank uses what's called an Islamic accepted bill. The bank literally buys the goods from the exporter, takes actual ownership, and then resells them to the customer at an agreed-upon markup, allowing them to pay later. It's a brilliant workaround that transforms what would be a loan into a legitimate trade transaction.
And when it comes to Islamic real estate investment trusts, or REITs, how do they handle messy commercial realities? Like, if a REIT owns a giant shopping mall, what happens if one of the tenants sells non-halal goods? Sharia advisors actually mandate a strict 20% maximum threshold for non-permissible rental income. This 80-20 split is clever because it ensures the primary core of the investment remains purely ethical, while still acknowledging the mixed, real-world nature of modern commerce.
For passive investors wanting a piece of the action, there are tools like Asia's very first Islamic exchange-traded fund, the My ETF DJIM Titan 25. This lets an everyday investor buy a single share that instantly provides Sharia-compliant diversification across 25 of the top companies. It keeps transaction costs super low while making sure everything stays absolutely ethically compliant.
Next up, Section 5, bonds versus Islamic sukuk. Debt obligation versus asset ownership. Listen, this is a massive distinction that you really need to take away from this explainer. A conventional bond is a pure debt obligation. You lend money, you get fixed interest back, and no specific underlying asset is required. A sukuk, however, is totally different. It's an investment certificate representing actual, tangible ownership of an underlying asset. Your returns aren't just interest pulled out of thin air. They are the actual cash flows generated by the physical asset you now partially own.
When you break it down, sukuk can be structured in a bunch of creative ways to fit these rules. You have ijara, which is essentially a lease where the investor acts as the lessor and receives rent. Then there's mudaraba, which is a pure profit-sharing partnership, and murabaha, based on an asset price plus a markup. The big key here is that across all these structures, there is no fixed un-Islamic return. The risk is truly shared.
What's amazing is that this ethical framework scales beautifully to the national level. A perfect example of this is the historic Sukuk Prahatin. During the pandemic, the Malaysian government needed to raise 500 million ringgit to help rebuild the economy, and they did it entirely through digital platforms like JohnPay. It just goes to show that asset-backed, Sharia-compliant financing can absolutely adapt to a modern, digital-first world.
Finally, Section 6, the Crypto and Forex Frontier, Navigating Unmapped Roads.
Okay, so when dealing with international trade, currency values bounce around. We call that exchange rate risk. Islamic scholars traditionally prefer on-balance sheet techniques, basically just pricing your exports in your home currency to avoid the risk altogether. But recognizing the realities of modern global business, regulators like BNM have conditionally permitted advanced hedging, like forward contracts, to lock in prices. But here's the catch. They have to be structured as a unilateral binding promise, known as a WAD, and they are strictly limited to protection. Absolutely no speculation is allowed, period.
Now, when we hit the ultimate digital frontier, cryptocurrency, the debate gets really intense. Prominent scholars, like Mufti Taqi Usmani, have strictly forbidden assets like Bitcoin. Their argument is pretty straightforward. It lacks intrinsic value, it isn't backed by an underlying asset or government, and it's primarily driven by speculation. Because of that, they classify it under the strict prohibition of maisir, which means gambling.
But despite those strong theological debates, the regulatory dashboard remains totally impartial and is rapidly adapting to reality. The Malaysian Securities Commission has formally registered specific digital asset exchanges, bringing them safely under regulatory oversight. They've even allowed the trading of specific cryptos like Bitcoin and Ethereum. And honestly, within the broader Islamic finance community, views span the entire spectrum. Some see it as halals, meaning allowed as a new type of currency. Others see it as makruh, meaning discouraged, all the way to outright haram or strictly prohibited.
So as we look through the windshield at the road ahead, we're left with a massive question to chew on. As money itself becomes programmable and our financial engines go completely digital, how will traditional central banks and ethical frameworks adapt to this decentralized future? The gears and wheels of finance are shifting faster than they ever have before, and keeping up with these mechanics is absolutely your best advantage. Thanks so much for joining me on this explainer, and I'll catch you on the next one.